Hello, check. Am I audible?
In progress.
Yes, sir, you're audible.
Great. Thank you for the feedback. Thank you so much. Right. So this was just an overview beyond what your curriculum says, because I wanted you to get an idea about firm's objectives. Because what happens is, as a mistake, generally when somebody asks you, right, what is the objective of a firm, because you are ultimately going to earn a degree called an MBA. And in MBA, when people ask what is the objective of a firm, people generally say profit, and that is highly criticized, because profit is not the sole objective, it's just a byproduct of what you do. And as a management student, you need to understand that the objectives of a firm is primarily to create value, and that's what I'm trying to explain you with the help of economics, that the objective of any firm is to create value for the stakeholders. Now when I say stakeholders, pay attention to this word, creation of value. One objective of the firm is creation of value or value creation. And who are you trying to create this value for? Please understand, we are not using the word shareholders, I am using a word called stakeholders. So when you are creating value, you are creating value for a lot of stakeholders. One, it is your customers, obviously, who are going to buy your products, right? It could be your owners or founders who want profits, or the entrepreneur. It could be your vendors or suppliers who are expecting some business out of you. It could be your employees who are expecting salaries and wages out of the business. It can be the government which is expecting taxation. It could be the society in general. It could be the publics who are expecting, for example, if I am a teacher, they expect us to create some value to the society and improve the scheme of things by educating people. So it could be the publics or the media. So the organization is supposed to create value, which is a neutral term for all of these. And if an organization succeeds to do this well, obviously it is going to earn profits, and it is also going to find a business that is sustainable. So profits and sustainability will only be possible till the time the organization is able to create and deliver value to the society or the stakeholders at large. So this is just one extra input that I wanted to give you, because generally we cover that in a great detail when we take classes on management and economics, but that's where they are connected. But for the ease of understanding the subject, as of now, we would only be focusing primarily on a term called profits, because other things would require a more mature understanding of strategy. So that is the reason why we consider profit as one of the goals, and we'll try to study the entire remaining part of the syllabus from the perspective of maximizing profits and optimally utilizing the resources. Is that clear by now? Is that clear to you all? So economics is all about optimal utilization of resources to attain better outcomes. Consumers can do it for better utility and utility maximization. Producers can do it for profit. Ultimately, everybody uses economics for their own benefit. Now, the important principles that can be used for taking better decisions. As of now, ये तो आप समझ गए अब कि economics is all about trying to optimally utilize resources and improve your outcomes. But now the question arises, how are you going to do that? And in order to do that, the firms and managers can use a lot of concepts which we'll discuss. We'll start with utility analysis. But before coming to those, I would still like you to understand some three very important principles, though we do more than 5 principles in general, but these 3 principles would be more handy for you to understand. The first is what we call as the opportunity cost principle. The opportunity cost principle. The second one that I'm going to use is called the marginal or incremental principle, the marginal or incremental principle, and the third one is the time perspective principle. Now you can also call them different sorts of analysis. I can also call them opportunity cost analysis, I can call them marginal analysis, and I can also call them the time perspective or the time analysis. But the point here is that these 3 tools turn out to be very useful in understanding the remaining part of the subject and also in taking better decisions. So I would like you to first understand these. You may not find them in detail in the SLM, but this would help you understand the remaining part of the SLM and the course very well. So what are these principles? We'll start with opportunity cost, and opportunity cost is the first principle of economics that says, before coming to it, let's first understand what opportunity cost is. So opportunity cost is what? You know that firms, when they try to assess their profits, profits are an outcome of what? Revenue minus cost. In simple words, what is profit? Revenue minus cost. So the accounting, in terms of accounts, the revenue that you have earned as a proceed of your sales and the cost that you have incurred on the production, the difference between the two is termed as profits, right? And these revenues and cost enter into the books of accounts, and that's why we call them accounting profits. So revenue minus accounting cost, the cost that is visible, that is going into the book of accounts, is leading to accounting profits. But economics gives you a concept of opportunity cost. It says that besides the cost that is visible, that is explicit, the cost that you are incurring, like you're incurring on raw material, you're incurring on labor, you're incurring on capital, but there is some hidden cost as well. And that implicit cost, which is probably either not visible, number one, or even if it is visible, it may not be included into accounts. And one reason could be that those resources might already be available to you. You might be the owner. Let's say you have a room in your house that is vacant and you try to do some business out of it. And once you calculate your profits, your revenue, you only include the variable cost, but you don't include the rent of the room because you don't have to pay a rent to anyone. But had you given that room on rent, you would have earned some rent out of it, and that rent which you could not earn because you utilized it for business is an implicit cost of the resource which you are not including. So the profit from that resource, from the second alternative that you could have used it for, becomes your opportunity cost. So this implicit cost is also considered as opportunity cost. That means you have lost an opportunity to earn some money out of that resource by not utilizing it for the other alternative that it could have been used. And this cost, if it is factored it into the books of into your calculations, you would be able to understand whether you are better off or you're worse off. You may be earning accounting profit. So let me give you an example of this. Let's say you were utilizing that room of yours and for running some tuitions or stuff like that, and you were able to earn some 15,000 rupees as revenue, and your expenditure, your accounting cost in let's leave aside the fixed assets like chairs and whiteboard and stuff, because that would spread across over or certain months. But let's say your running expenditure comes out to be 3,000 rupees. So that's your accounting cost that you have included on markers, duster and stuff like consumables, and 15,000 is the revenue that you are earning. So your accounting profit becomes 12,000, right? 12,000 is what you were earning. But had you given this room on rent, or because this room belongs to you, you did not include the rent here. But had you given it on rent, there is a possibility that you could have earned some 10,000 rupees as profits or as rent out of that business. Now you could have earned 10,000, but you have foregone that opportunity, and the opportunity foregone is a cost to you. Please remember this line. An opportunity foregone or lost is a cost, and that's why we call it opportunity cost. So the profit you could have generated out of the other alternative becomes a cost, but we can't call it accounting cost, so we call it economic cost. What do we call it? Economic cost, or the opportunity cost rather. This is the opportunity cost. 3,000 was your accounting cost, right? And combined together, this becomes your economic cost. So economic cost is accounting cost plus opportunity cost, which is 13,000 rupees. Now if I deduct that out of the revenue, my actual profit comes out to be 2,000 rupees, right? 2,000 rupees. Now what does that mean? It's an accounting profit. If it is an accounting profit of 12,000, the economic profit is only 2,000. What does it mean? It means that the difference between the two is nothing but your opportunity cost, which means something that you could have earned from the second alternative, you did not earn, yet you were able to earn 2000 rupees above that. So economic profit shows that you are more efficient, than the second alternative, and that's a good idea, that you are doing, or you're utilizing the resource in the best possible alternative. So if the accounting profits are high, that doesn't mean that the firm will, it's good for the firm, but it doesn't mean that the firm is doing comparatively better than others who are involved on a business of similar risk, and the firm has better opportunities available. But if the firm is able to earn economic profits, that means the firm is into the probably a better alternative, rather than having utilized that resource into some other alternatives. Now, why does this become an important principle? This becomes an important principle because we have seen a large number of firms in the market. If I talk about automobile companies, please mute your mic because I'm talking something very important. If I talk about automobile companies and compare them with IT companies, you would know that automobile companies once were probably the companies which had a much larger investment compared to IT companies. Imagine those huge buildings and infrastructure, the runways to test their cars, robotics, and on supply chains to produce those big, big fat investments on making cars. And these companies had a huge investment, their profits were also high. But if I talk about the ROI means what percentage were they able to earn on their investment. These ROIs were relatively lower, right, which I'm now considering as economic profit. That means if these firms would have invested these amount of resources into businesses like IT or banking, the profits levels would have been much higher than what they have been earning, right? And that means even if the accounting profits are high, the economic profits of these firms are much lower than the IT and the banking sector. The IT and the banking companies had much higher economic profits, and that's the reason why over the decades, over half a century, what we have seen is the IT companies have, and the consultancy companies, the IT companies have now become the greatest companies of the world compared to the biggest companies that we studied in the past when we talked about General Motors, Toyota, and others. So what is it showing? It that economic profits, these firms have smaller accounting profits, but then their accounting profits may be much more than what they could have earned by being into some other businesses of similar risk. And that means that they are more efficient. So economic profits show a higher level of efficiencies in the business. That means the firms are performing better in this particular alternative than any other alternative they could have worked on. So opportunity cost principle says that the resources should be allocated in such a rational manner that the firms are able to not only cover up their accounting costs, but they are also able to cover up the opportunity cost. That means the firms are able to cover up their economic costs and able to earn economic profits. I hope you have been able to understand this, that if the firms are earning economic profits, that means they are far more efficient. Accounting profits alone do not give a very clear picture. But yes, economic profits will always be lesser than the accounting profits in absolute terms. Why? Because accounting profit is revenue minus accounting cost, while economic profit is revenue minus accounting cost plus opportunity cost, which we called as the economic cost, and so if this cost is definitely larger than the accounting cost, the accounting profits will be larger in numbers than the economic profit. But slightest of economic profit shows that the firms are very efficient. So firms can have high economic profits or reasonable economic profits, which means that they are earning high accounting profits. If the firms are earning probably low economic profits, still it means that they are earning reasonably good accounting profits. If the firms have zero economic profits, they may still be able to earn accounting profits. And if the firms are earning negative accounting economic profits, which also means economic loss, then it means that they are less efficient than what they could have, and they must probably leave this and get into some other field which can give them better returns. So this is, but obviously it's not that easy. Big firms cannot just quickly close their business and move into something else which they may not have an idea about. But this is from the perspective of resource utilization. So जब भी आप decisions लेते हैं resource utilization के, you must see that whether you are able to cover up your economic profit, economic cost, or your opportunity cost. The last example for this I can give you for a better understanding is that, for instance, if you calculate the cost of the degree, you would be taking into account the fee that you have paid for this particular degree. You might even include some investments into books and other things if you would have done them at your own level, your cost of living if you were relocating, your examination fee and stuff like that. So what happens is you are factoring all the accounting costs, right? All the accounting costs. But how do you factor in the 2 years that you have spent into it? How do you factor in the opportunity of doing a full-time job that you may not be in a position to do because you are earning a degree, right? So that opportunity lost is an opportunity cost. So it says that if you keep in mind these costs, I'm giving a very philosophical answer now, not just technical. If you factor these things in mind, you will be more serious about optimally utilizing your time in this degree. You will be more attentive in doing the degree. You would understand what all is at stake when you're doing this degree. You would not just see the accounting cost, but you would also see the opportunity cost of time, opportunity cost of your efforts, opportunity cost of your abilities, opportunity cost in all those factors that in terms of time will not probably come back so easily. So if you are able to do that, obviously you would perform better because you understand the importance of time, you understand the importance of all the opportunities that you have lost, and by doing this you may be in a position to do better, and then able to cover up what you have lost as an opportunity. In simple words, you might miss a trip to Missouri, right? A trip to Missouri when there is snowfall. Focus more on the degree, but once you do well, you earn better incomes and salaries. Who knows, you might go for a week-long stay at Switzerland, and that's what makes you feel that you have covered up your opportunity cost. So this is more philosophical, but technical means when you're evaluating a resource and seeing where should you invest that resource, try to see the best possible alternatives, and keep in mind that the second best alternative is a cost, because second best alternatives opportunity is something you have lost. So I give you example, people sitting in showrooms, if they earn 50,000 rupees a month, that may be good enough for them, but they need to also assess if they gave the showroom on rent, what is it that they could have earned. If they could have earned 40,000 rupees out of it, then the economic profit is just 10,000. Now, is it worth for those people to sit at the shop, invest their time and energy, or they could have easily traded that off with the second best alternative, with sitting at home easily earned 40,000 rupees, and probably the expense that they are doing on going to the showroom, spending the whole day, getting their tiffins, getting their food, and doing extra expenditure, could have well been covered, and they could have done something else with the available time. So you need to understand that aspect. And some firms that do not grow fast, that happens only because they are complacent. They are complacent with their accounting profit. A lot of firms are very complacent with accounting profit. Kitna aa raha hai, kya dikkat hai? But they forget that if they are not factoring in the economic cost and they are not seeing the economic profit, they might be growing slower than the other firms who might be growing much faster than them. I hope you've been able to understand this, because your first assignment will be based on this. I'll give you a very holistic view about this in real business perspective through the first assignment that I'll be giving to you. So you should be very thorough with this concept that I've shared. I hope this is clear to you. So which profit would normally be larger in terms of absolute number? Accounting profit ज़्यादा आता है या economic profit ज़्यादा आता है?
अकाउंटिंग प्रॉफिट सर.
Good. But which is more favorable? हम क्या चाहेंगे कि हमारे accounting profits हों या economic profits हों? Does accounting profit guarantee economic profit?
नो सर.
No. But economic profit certainly guarantees you accounting profits, high accounting profits. Yes?
यस सर.
Yes. So that is what I'm trying to tell, because people generally get confused. When I say accounting profits are larger than economic, तो हम ये मानते हैं कि accounting profit important है. No, accounting profit ज़्यादा आ सकता है, but economic profit अगर आ रहा है, that means you're performing better, because economic profit not only guarantees accounting profit, but it also guarantees that you are more efficient in your resource allocation, because you are able to cover up the opportunity that you have lost through the second best use of the resource. आप अपने resource को जो second best use में लगा सकते थे, उससे जो earning कर सकते थे, वो भी आपने cover कर ली है, and that means you are more efficient and obviously more effective in utilizing of your resources. So that was one important aspect that I was trying to share with you through the first principle. Now once we are clear with this principle, we can move to the second principle, and this principle is related to marginal analysis. We also call it marginal analysis, and then I'll talk about the marginal principle. In economics, what we do is we already know, it's a sheer common sense, we have already come across terms like total, and we know what is average. So we know total values and average values are very important in analysis, in a lot of analysis related to day-to-day life. For example, when you talk about your percentages, you talk about your results, you talk about your scores, these are examples of totals and averages, right? So if I need to understand what was your score in a math exam, or what was your composite score in a CAT exam, or how well you performed, I might ask you, how much did you score out of let's say a thousand band number. So this is what shows the total value, right? Total is very important in certain areas. Like for example, if I'm trying to measure the firm's turnover, I'm trying to find out the firm's revenue, I'm trying to find out the firm's profits, I'm trying to understand the firm's cost, it's very simple that these total values will give me a holistic picture, a total picture, an absolute picture about these aspects. Sometimes the averages play a very important role. Now, in what scenarios? In certain scenarios, the total does not give a clear picture. For example, if I ask how many students in the class have scored the first division, the total might give you an idea. You might say that, okay, probably 60% of the students in the class have first division. That means a 60-40 breakout is there. You're still banking more on the total values. But if I say what is the average percentage of the class, and you say the average percentage is 73%, now it is a much easier generalization of the performance of the students. However, we do not know how skewed the data is, because averages can be more skewed. You might have a few people who might have scored a much higher percentage, pulling up the average figures, but still it's a much better generalization that is in comparison to total, because you cannot find out how the entire class has been performing. So totals and averages are fine, and we would be using these values when we talk about utility, when we talk about cost, when we talk about product, when we talk about profits, we'll be utilizing these terms. But economics heavily relies on another and the third important tool of analysis, what we call as marginal. So marginal analysis is more about trying to understand more qualitatively the change that is occurring. That means if for example, I'll take a hypothetical case. If I consume 1 unit of a cold drink, a glass of cold drink, and a hypothetical belief is that it gives me a satisfaction on a scale which I would rate at 10. So it gives me a rate of satisfaction at 10, and when I consume the second glass, we all know, which I'll do in detail in subsequent classes, that let's say the satisfaction level goes down because some of my thirst is already quenched, and it might go down to, let's say, 7. And then when I have the third unit, it comes down to 2. Now what is happening is that if I look at the total satisfaction that I have got out of the consumption, the total satisfaction out of the first unit was 10. After the consumption of 2 units, it became 17, and when I consumed 3 units, it was at 19. So as long as the value is increasing, it does not give me a very qualitative picture unless you are very apt and it at understanding the rate of change. So it is the marginal value. Marginal means the change in the outcome variable with every subsequent change in the input variable. So with 1 unit change in the input variable, what was the change in the associated output variable is a marginal analysis. So if I moved from first unit to the second unit, what was the additional satisfaction that I was getting, or what was the change in the satisfaction? So I found that the additional satisfaction 17 minus 10 was 7, while in the third case it was 19 minus 17, which is 2. So the qualitative change in behavior is very beautifully reflected through a marginal analysis, and that's why the marginal analysis will be used predominantly at a lot of places where total and averages may not give a very clear picture. So the purpose of this rule was for you to understand that when people spend a rupee, now I'm giving an example of equimarginal principle, the way it works, but in a very simple way. When you spend your money, you go to a departmental store. Let's say you want to buy a pack of French fries, right? You want to buy a pack of frozen fries, and you find that the 1 kg pack costs you 50 rupees. It's for 50 rupees, right? While when you look at the 500-gram pack, when you look at the 500-gram pack, it is costing you 30 rupees. So what sort of analysis do you generally do in your mind? You try to take an average, right? You try to take an average, and what you do is, if you say that I'm getting 1,000 grams for 50 rupees, that means how much am I spending, which is a much better alternative for me. So you know that for every rupee that you spend, right, 50, you are able to get a certain level of grams, and which is 20, probably 20 grams that you are earning. But if I talk about this case, it is less than 20 grams that you are getting for every rupee that you are spending. How do you do that? Obviously, you divide the total utility divided by the cost, and you find out what is the average return that you are getting, and you find that this is a better alternative. But this is only from the point of view of average, and this is only from the point of view of efficiency. However, sometimes your decision also has to see that is it really that you would consume a 1 kg pack? I'm giving a hypothetical case. If it was a perishable commodity, in this case it was frozen fries, so they don't perish so easily, you can keep them in the refrigerator. But otherwise, it could have been that it was a perishable product, or there is not enough of consumption because you are the only one and you don't consume it much. And in that case, you would like to trade it off with a 500-gram pack, because what you think is that the slightly extra money that you are paying, the 5 rupees that you are paying extra in this case, which for a kg turns out to be 10 rupees, is okay, because you are still saving 20 rupees by not unnecessarily increasing your spending to 50. So sometimes people use this kind of marginal analysis also to see whether it is really sensible for them to spend a 20 rupee extra in order to save a 10, or in order to save a 10 rupee, they are ending up spending 20 rupees over and above what they are required to spend. And this is what happens when you go for sales, right? Sale is a good way of encouraging people to do that. So what you do is you look at a shirt which was otherwise costing you 5,000 rupees, you find that it's on a discount of maybe of 2,000, and but it's only possible when you buy 3 shirts, you get it for the price of 1, and you believe that you have bought shirts worth 6,000 rupees, 15,000 rupees, 3 shirts, by only paying 6,000. But what happens is, in normal course, you did not require a shirt and you ended up spending 6,000. So it has to be understood from that perspective. But now when I combine the two principles, the opportunity cost and the marginal principle, it becomes a very interesting sort of scenario. Now, how does it become so interesting? Let me give you an example, and it will give you a very, very clear understanding of things. Let's say you are standing on the roadside at a place X, and you want to travel to a place Y. So from X to Y, you want to travel, right? Okay. And you are waiting for some mode of commutation. So there is an option. You can hire an auto. One is an option of an auto. The other is that of a city bus that can take you to this place. And a city bus, to travel this distance, might cost, let's say, might charge you 10 rupees. while an auto would charge you something like a 50 rupees. That's the going rate. That's the going rate. Okay. And now what happens is you find that an auto rickshaw comes, he passes by, and the auto rickshaw one asks you if you would like to pay 50 rupees and reach this point. Now you are a rational consumer. You believe that the commutation expense in a bus is just 10 rupees. What is the purpose of spending 50 rupees on that? You refuse the auto rickshaw to pay 50 rupees. You say, well, if it is something like a 30 rupees you would have charged, I would have gone. He refuses and moves ahead further. This might have happened many a times in your life. And you find another auto rickshaw coming, A2, and sometimes when he asks you, would you like to come to point B, you say, no, I'm not going to pay 50 rupees, I'm waiting for the bus. And he gives you a very interesting option and says, madam, you pay me, or sir, you pay me 30 rupees, and I'll drop you there. You find that to be okay because you don't have to wait long, you don't have to share the seat in a bus, the chances of a lot of people traveling with you, and it's much safer and convenient to go by an auto, and you do that. Now if you look at the two examples, now what happens is, on one hand we might believe that auto rickshaw one, he did not accept a discount from your end, right? And he left an opportunity in this case. And while he traveled all the way to place Y, probably he had some work, he might have been going in that direction, and he's spending on his fuel. He might be spending, let's take a hypothetical case, he spends 10 rupees as a cost to reach to place Y. Now what happened? Had he charged you 30 rupees, he would have spent 10 rupees going the entire distance and earned 20, right? But he did not do that. So auto rickshaw 2 did that and earned 20 rupees, while if you look at auto rickshaw 1, he did not charge you anything, and he went, he did not take the passenger, and he went to that distance, and he ended up making a loss of 10 rupees. Now if I look at this principle alone, right, the marginal principle, what it shows is that if I had to in any case spend 10 rupees, instead of looking at a total profit of 40 rupees, that is 50 minus 10, even if I earn 30 minus 10, which is 20, I am not at a loss. I am able to cover my cost, and it is still profitable. Agreed that the profit is lower, but I am able to earn a profit. In this case, obviously, auto rickshaw 2 was more sensible. Yes or no? Yes or no? I hope you've understood this part.
Yes, sir.
Now we combine it with the second principle, because in real life these principles will not be in isolation. It's pehle I am just for the ease and convenience trying to teach each principle independently, but in real life the decisions become more complex because all these principles have to be collectively applied on a decision. Now what happens? Take scenario 2. Scenario 2 is that this auto rickshaw 1 did not take you as a savari, and when he moved ahead, he was sure that he would get some other savari, because this is the peak time going on, and at this time you generally get passengers easily. And he found another savari at this point, right, who could have paid him 50, or maybe because the distance is shortened he could have paid 40 rupees, but I am taking a hypothetical case of the going rate of 50 rupees. Now what happens? He missed this opportunity, right? But he was at a loss. But after that, he expected that he would still have an opportunity awaiting him, and he is able to get a savari for 50. And if you now look at his profits, he has now earned 50 minus 10, which is 40 rupees. Now if you see, who is better off? A missed the opportunity of earning 50, and B was able to leave the initial opportunity of 30 and avail of 50. In this case, who's better off? It is A1 that is better off. So from an opportunity cost perspective, as of now, if you see, A turns out to be better off, but from a marginal cost perspective, A2 turns out to be better off. Now, how do firms take decisions? If you are sure, if you are certain that you would have got this opportunity, this would have been the peak time of business, you could have managed to lose this opportunity and avail this. But what if you are not able to get this opportunity? It would end up becoming a loss. So what some auto rickshaw drivers do, and that shows how economics works implicitly in their mind. some auto rickshaws play a game. They tell you that sir or madam, because they suspect there is an opportunity waiting, but they also know that because it is a peak hour, maybe they have to reach there. They can't just stop at this stand and wait for a savari. They in any case have to go in this direction. If that is the case, they know in any case they have to spend 10 rupees. So what they do is, in order to lure you, they ask you for 30 rupees, right, or 20 rupees or whatever it is, which is above the cost and lesser than the going rate. But they put a condition. They say, madam or sir, I would give you a discount, but in case I find one more passenger on my way, I would like to take him in, if you do not mind, right, and I'll charge him extra, but I'll give you a discount. So I take you for 20 rupees or 30 rupees, and I'll take the other savari if you're okay with it. Sometimes you might have encountered this situation in life and you would have said, that's fine, it's still better than waiting for a bus or sharing a Vikram with 8 people. And what happens is, he moves ahead. Now he has ensured the marginal principle and the opportunity together. In case he don't find a savari on the way, he ends up earning 20 rupees, and in case he gets another savari out here, he might give him a discount again, charge him 30, and now he ends up earning 60 rupees minus 10 and a much more profit than A1 or A2. And that's how A3 is able to earn better profit, if you see. Why? Because he has now considered both the opportunities together. So we would discuss this more from a case study perspective in future when we will talk about situations. I'll keep giving you small examples and situations where you would have a better understanding of this. But as of now, what I wanted to show you is that what are these principles and how they are used collectively in decision making. I'll take another very interesting example once I am done with the third principle. So now let's come to the third principle for the day, and the third principle is called the time perspective principle. This is very simple, the simplest of all. So you'll very quickly understand this, but this principle is also to be included in economic decision making. So I call them as principles or tools of analysis. They're very useful, and if you apply them in real life, you're bound to take better decisions rationally and more often than a wrong decision. So what is a time perspective principle? It says, it's very simple, that you need to factor in the element of time in your decisions, and in order to make your decisions more effective. Now, what role does the time play? So again, like opportunity or like marginal, let's first understand what role time plays, and then how time can be taken into perspective. So to understand this, let's take this case that time is probably one of the most important resources that we have studied, if you remember. When I talked about resources and optimal utilization of resources, I told you time is probably the most important resource. The time is ticking, and it's very difficult for you to regain and recover time. Time doesn't come back again once lost. It's just that you can increase the value of your time by increasing the opportunity cost of your time by utilizing it in the best possible manner. So time is a very important resource. There's another saying that time is the biggest healer. That means that time can change the situation and the scenario and can change the outcome. So let's take an example. Let's say you travel from your place, your home, your residence, to your university or your office, right, every day through a bus, city bus, and city bus charges you 10 rupees each side, 10 rupees each side, right? And that means you end up spending 20 rupees every day. Now 20 rupees multiplied by roughly 25 days a month, you end up spending 500 rupees on your travel. 500 rupees you find is to be a reasonable amount that the bus charges you. On one fine day when you were traveling, the conductor tells you that the rates have been revised and they are now going to charge 15 rupees per side. 15 rupees per side. What does it mean? That from now you are going to spend 30 rupees every day, and that would account to somewhere around 750 rupees for you to spend. Now, from a hypothetical perspective, every person have a different financial capability. So as I said that for a richest person in the world, he may not be as rational as you spending his resources because he has enough. but for a rational consumer, it is a hike. It is a hike of 50%. The prices have gone up by 50%, and which is a big amount. Now, on that